Hello, I'm Dr. John Prudhont, DBA and MBA in Financial Management and Finance, respectively, an entrepreneur, business, finance, and mergers and acquisitions expert. In this video, we will look at the efficient market hypothesis and an overview of investment techniques that can be used to hedge the inherent risks of investing in stocks. Any discussion of techniques to achieve exceptional returns in a market should be based on an evaluation of the perfectly imperfect efficient market hypothesis, or EMH, developed by FAMA in 1991, and how this hypothesis provides a basis for informing our investing decisions from time to time. The EMH provides a framework for broadly looking at financial markets to inform us on which tools and techniques might provide successful results when investing in a developing or developed financial marketplace. We will also look at some of the basic approaches to investing that can be used in concert to spread your risk versus reward potential. As we progress through this process, we will look at the effects of market inefficiencies on our ability to predict changes in value that can lead to unusual returns. We will also investigate some strategies that stakeholders can utilize to influence firm value and share price to provide insight into how you can positively affect share prices. As you investigate not only the past performance of each potential investment, but also the market positioning involving competitive advantage, you will also see how the structure of corporate governance should be incorporated into your determination of which investment instruments to buy, when to sell, and when to buy again. The EMH posits that a market is efficient if it satisfies the following criteria. 1. All information is immediately available for assets on the market, generating correct pricing for each asset due to investors reacting to the information rationally. And 2, that new information is immediately used to correct and update prices. This suggests that technical and fundamental investment schemes do not produce abnormal market returns. The EMH does not suggest that efficient markets are immutable or unchanging market states, but acknowledges that market inefficiencies vary over time. In an attempt to address the variable qualities of market efficiencies, the EMH suggests that there are 3 sub-market efficiency classifications: a weak form market efficiency, a semi-strong form market efficiency, and a strong form market efficiency. A market has weak form efficiency if stock prices instantly and fully reflect the past price information only. A semi-strong form of market efficiency reflects markets where stock prices fully reflect all present public information and past price information. A strong form of market efficiency is found where stock prices fully reflect all public and inside information. So what are some of the anomalies of the EMH and how do they apply to the efficient market hypothesis? The joint hypothesis problem argues that EMH cannot be tested by itself without using some type of asset pricing model. If the EMH cannot be tested empirically, then how do we know if it can be used as a tool in practice rather than being looked at as a nifty theory? One pricing model that can be employed with EMH is the Capital Asset Pricing Model, or CAPM. However, utilizing variance as a measure of risk-return distributions normalization presents challenges to its credibility. Researchers have concluded that there is no scientific way to measure the level of market efficiency. If there are no effective methodologies for determining if a market is in weak form, semi-strong form, or strong form market efficiency, then how can we arrive at a reliable method for using the most robust strategies for exploiting opportunities to outperform the market? Funding liquidity has been shown to increase market efficiency and stimulate significant fluctuations, with better funding liquidity increasing systematic market efficiency. In other words, a market with more capital flowing through the market tends to generate more investment in market infrastructure and a resulting information symmetry due to a more developed market compared to an emerging market. Additionally, there appears to be a short-term momentum effect where stocks that outperform in the short term will continue to outperform in the long term. Increased volatility reduces market efficiency depending on the influence of the economic environment in the market area. Market volatility increases the amount of both good and bad relevant news that is available, decreasing the speed and distribution and assimilation by investors. Even with the velocity of distribution through the internet and financial models driven by artificial intelligence, information must still be located, viewed, analyzed, and digested by the human mind before an investor can make a decision and execute a buy or sell order. Another anomaly is that the introduction of new information has been shown to create lags in repricing to total value regardless of the perceived level of market efficiency. Lags in repricing can result from information asymmetry or fear among a significant pool of investors. Hedge fund assets under management, or AUM, increases results in improved market efficiency. The proportion of capital being managed by professional asset managers, hedge funds, mutual funds, pension funds, etc., in each market appears to increase the level of more structured, systematic, and logical buying and selling decisions due to a lower level of emotional decision making based on traditional security analysis when buying and selling investments. Different levels of market inefficiency create opportunities for abnormal returns, and in inefficient markets, average abnormal returns were significantly higher on the announcement days and 2 to 3 days after it. Imbalances in orders in the short term have been found to support this view. Regardless of the level of information efficiency, efficiency gains do not mean that the market will respond rationally or accurately. Weak form market efficiency has been shown to offer abnormal profit opportunities due to a lack of easy access to metrics for most investors, resulting in an inability to chart patterns to predict future potential movement in value. The EMH doesn't consider the impact that behavioral economics has revealed influences investment decisions related to the irrationality of humans. On the flip side, reactions to financial crises evident in buying behavior indicate that individual investors are less emotional during times of extreme economic uncertainty. Crisis periods have been shown to affect the value premium in semi-strong form market efficiencies, with reductions in the value premium and reduced levels of market efficiencies, and provide opportunities to outperform the market based on the ratio of value and growth stocks in the portfolio. Even though information asymmetry in a weak form market can make the investment decisions riskier, since a stock might react differently if insider information were more readily available, there may be opportunities for higher than average market returns due to the observation of investors acting irrationally. A market in a semi-strong form of efficiency provides investors with the opportunity to use publicly available information to predict future security prices and earn abnormal returns. By determining events that will affect stock prices beneficially and buying the stocks as soon as the information is available, abnormal returns can be locked in by liquidating the stocks within the next few days after purchase, with the converse being applicable of liquidating stocks on the first day that bad news is released and then buying back the stock in the following days when prices will be theoretically lower. Other basic strategies for inefficient markets are technical trading rules like a buy and hold strategy and a sell and hold strategy. A buy and hold, or BH strategy, assumes that prices rise in the long run and advises investors to continuously engage in long positions. A sell and hold, or SH strategy, assumes that prices decline in the long run and advises investors to continuously engage in short positions, and has been found to yield the most profitable system with a profit factor greater than 1 in a weak form market environment. A variable length moving average, or VMA strategy, recommends that an investor take a short position when a short period moving average falls below a long period moving average. If a short period moving average is above a long period moving average, then the advice is to take a long position. A VMA strategy has been observed to reveal recurring price patterns resulting in increased returns in a weak form market efficiency ecosystem. VMA outperformed the SH investment strategy in a weak form market for periods of 1 to 2 days and for extended periods of 50 to 100 days, yielding profitable indices in excess of 50%, depending on the relative investor's choice of short or long trading periods in developed markets. Another technique, referred to as a trading range breakout, or TRB technique, is to take a long position when the price penetrates a local price maximum and to take a short position when the price penetrates a local price minimum. In a weak form market efficiency environment, TRB has been observed to be the least risky choice of investment techniques compared with VMA. The random walk hypothesis, or RWH, asserts that asset price patterns are random and that charting of prices is not relevant due to patterns not being predictable. As a response to the asserted arbitrariness of a market, the RWH suggests that an investor take a long position when the price today is higher than the price yesterday, and to take a short position when the price today is lower than the price yesterday. The RWH is a reaction to the EMH that rejects traditional security analysis, since EMH assumes that an efficient market reflecting all available information for a stock will not yield opportunities for unusual gains in investment based on insider information not being available to the public. The contemporary security analysis process perceives indirect rewards coming from risk return. It is argued that in a weak form market efficiency, stock prices do not yield trends in line with the RWH due to stochastic changes. The adaptive market hypothesis, or AMH, suggests that the market moves from different stages of efficiency and inefficiency due to the behavioral finance observations that investors can act irrationally in response to behavior or other psychological factors, including overconfidence, overreaction, and fear of loss. The value-added intellectual coefficient, or VAIC, suggests that there are three types of capital that should be evaluated before making an investment decision due to their influence on firm performance and related asset value. The first category is physical and financial capital, which can be determined by looking at how physical and financial capital is employed and if the capital is employed efficiently, or CEE. This can be done by comparing the metrics of whether a unit of capital is being utilized to produce better returns than other firms. The next segment involves human capital and at what level human capital efficiency, or HCE, is present. HCE shows how much value added is generated by the release of funds for labor. The final element to be determined is structural capital and the structural capital efficiency, or SCE, of the underlying business. VAIC posited that the intellectual capital elements of capital employed efficiency, human capital efficiency, and structural capital efficiency are significantly correlated to return on assets, or ROA. When evaluating an investment, a fundamental technique to use is to look for a competitive advantage. Some of the questions to ask are whether the business and products are valuable. Is the product or service that the firm offers based on rare components that the company controls and is limited in supply to competitors? Is the product or service that the firm offers imperfectly imitable? In other words, is it not easily produced by other competitors exactly? Intellectual capital is an example of something that is valuable, rare, and perfectly imitable, which has a very important role in innovation, productivity growth, competitiveness, and performance of companies. Is the product or service imperfectly substitutable, which reduces the possibility of competition with other businesses that might produce products that a consumer might substitute for buying the products produced by your target acquisition? Additionally, if you identify that the company has a competitive advantage, is it a sustainable competitive advantage? When attempting to identify whether a company has a competitive advantage will only occur in situations of resource heterogeneity, resources that differ between companies, and immobile resources where a competing company cannot obtain resources from other companies. A company financial assessment is another key component to making an informed investment decision involving whether to buy an asset. Two financial statements that can be useful in determining the financial health of an asset are the balance sheet and the income statement. Some basic ratios to consider when determining whether to buy an asset based on financial statement review are, when assessing value stock buys, the top 30% of each indicator against growth stocks, the bottom 30% of each indicator. Many empirical studies have found that value stocks with higher ratios of book to market, or B/M, earnings to price, or E/P, cash flow to price, or CF/P, or dividend to price, also known as D/P, outperform growth stocks with lower corresponding ratios. The book-to-market ratio can be performed in two ways. One, the company's market capitalization can be divided by the company's total book value from its balance sheet. Two, using per-share values is to divide the company's current share price by the book value per share found on the balance sheet. The earnings to price, or price-to-earnings ratio, is the market price per share divided by the annual earnings per share, which can be found on the income statement. Cash flow to price is calculated by dividing the share price by the operating cash flow per share, which is found on the cash flow statement, and the dividend to price is calculated by dividing the share price by the dividends paid per share in the statement of cash flows. How can financial stakeholders affect the efficiency of the market? One of the major challenges that can affect the efficiency of a market is information asymmetry resulting from the agency dilemma and associated agency costs due to managers' decisions potentially being in their own interests at the expense of stakeholders' interests. To counter this phenomenon, corporate governance initiatives can be undertaken and reviewed by investors to gain insight into the strength of corporate governance controls. Strong corporate governance controls can improve the potential for efficient investment allocation. One of these controls involves the need for a higher level of board independence, which should include different individuals holding the positions of Chief Executive Officer and Board Chair. Board independence can provide oversight that lowers the risk of fraudulent activity that could damage asset value. Institutional ownership can diffuse self-serving actions by the Board of Directors and management through exercising oversight based on the strength of their ownership position. Outside director ownership involves ensuring that the Board of Directors has a significant representation by board members who are not employees of the firm and have stock ownership in the business to increase the influence of stockholders in decisions that affect stockholder value. To ensure that the CEO's decisions and policies are in line with creating shareholder value instead of simply adding CEO income at the expense of the shareholders, CEO equity-based pay should be incorporated into the business from which the stock is issued. Companies that have CEO equity-based pay have been shown to benefit from increases in stock value after acquisitions are announced, in comparison to stock value decreasing in similar situations where CEO equity-based compensation is not present. Part of the theory behind this component is the self-serving motivation that a CEO will make decisions that contribute to increases in shareholder value if a substantial component of the CEO's compensation is in company stock. Audit quality is required to ensure the competence and veracity of the entity's financial statements, to reduce the potential for fraudulent financial activity in the firm and shareholder value dilution, and requires the coordination of the outside auditors, the audit committee, and internal auditing controls. Audit committee quality and meeting frequency are also key components of the firm's governance system due to its oversight of the other two legs of audit quality: management, financial decision evaluation, and discipline responsibilities. The change in excess value around asset purchases is positively related to the change in the investment efficiency of diversified buyers with better internal governance structures or stronger shareholder protection. I'm Dr. John Prudhont, Doctor of Business Administration and Financial Management and Master of Business Administration and Finance, entrepreneur, finance, business administration, and M&A expert. Thank you for taking the time to learn about the importance and application of competitive advantage for businesses. Please contact me at johnprudhont@gmail.com with questions or to book me for speaking engagements and appearances.